Welcome to FinFactor. I'm your host, Blaine Bertsch, co-founder and CEO at Driver and Cash Flow Forecasting Software, where we help the office of the CFO leave spreadsheets behind and model everything from cash flow through to complex scenarios with clarity and control. And joining me today is Rafael Pinho of TD Pine Advisors, where they provide CFO consulting and help businesses manage key financial drivers and exit strategy planning. And today we're diving into who's buying and what they're really looking for in today's M&A landscape. Welcome to the show, Rafael.
Thank you for having me, Blaine.
So first off, I want to dive in a little bit on the different types of buyers that you would see and how they're thinking about these deals.
Absolutely. Thanks for that question. People tend to think about there is only two flavors of buyers, PE and strategic, and that's a misconception. There are several types of, other than those two obvious candidates, but you also have a plethora of types of family offices. You might have your own in-house structured, either MBO or ESOP. You have today, there is a surge of search funds. And those guys are another type of buyer who we are interested in understanding. And I guess most of the potential sellers out there just think of the first two and forget that they should be understanding all the others to position themselves in order to maximize value.
So let's start talking about, because there are a whole bunch of different ones there. So let's start talking about each one and just give me a little bit of a rundown on some of the earmarks. So let's start with private equity. What are some of the main things that you see in a deal driven by private equity?
Private equity has some pretty very well-defined guidelines to understand a private equity deal. They have a very strict mandate in terms of they want to buy a company, grow, and flip it within a certain time frame, and that time frame is the actual fund time frame. So they had promised to their investors that they will return the capital over a certain period of time, and that's the lifetime of the deals within that fund. Other than that, they're normally buying for what it is there today. So they're not buying into future growth. They want to execute that future growth and they want to reap the benefits, reap the value out of doing that. So that's a very critical thing to understand when dealing with PE. They are pretty much running on a very well-defined playbook. Now, if you go for a strategic, the playbook is different. Strategic is normally buying a company because they're looking at some sort of synergy, either revenue side of things or strategy in terms of expansion, or on the expense side of things and saving, either by providing more cost efficiencies or back office consolidation, something that unlocks value within the deal for them. It's a very different value proposition. For instance, if it's just consolidation and they're just consolidating markets, yes, it will lead to reduction in the overhead of the existing company, probably. So it's something to consider. Another type or flavor, as I prefer to call them, family offices. Family offices are more generational. Family offices are what we normally call patient capital. They are there for that legacy. They are there for long-standing, long-term deals. They want to make sure that they are profitable and they yield enough for what they invested, but they're way more patient and way more forgiving in terms of timing and, say, market cycles, as opposed to the other players. If you are strategic, normally maybe you're listed, so you have shareholders, so you need to deliver. And as a PE fund manager, I already told what the deal is. So with families, they tend to be more forgiving on one hand. However, that comes with a cost. They tend to be less deal-driven, less agile. They tend to take their time. They just do a deal if they feel that it's absolutely right for them. And some sellers won't, say, have the patience to deal with that type of buyer. Last but not least, search funds. Search funds are a recent thing. I mean, they've been around for a while, but now they're starting to make it to their headline. Normally, some operators, someone that exited the industry as an employee and wants to own a business, or even someone with money that it's an exile from corporate America and now wants to run a business. They're looking for business to buy and manage. For those guys, it's all about what happens the next day. Would that transition, that management transition happen? Would that be successful? And guess what? there are even some search funds out there that are really funds. They have investors backing them. So in a sense, they will resemble a little bit of the PE playbook, but they're all different in their ways. You've got to be careful. Bottom line, when you're selling your business, you're normally having a partner at least for a few years. And when you're choosing a partner, you got to make sure that you're selecting the right partner. That's the key thing.
So I'm curious about the different timelines on these different ones, because you talked about private equity all the way through to these search funds, which I'm not familiar with at all. What sort of different timelines do you actually see with these kind of four different types of buyers?
Okay. The typical private equity fund is going to have a 7-year term, which means that they're going to invest today thinking of an exit within 5 to 7 years, ideally 3 to 5. Why is that? The quicker they turn around the capital, either it gives them the opportunity to flip it again, or they are making a safe bet. They're never wait to sell at the very last moment and minute, because that's probably a more riskier proposition. Now, let's think of the strategics. Strategics, their timeline is really difficult to be precise on, because it all depends on what that management, what the shareholders of that company are expecting. So that's
Mhm.
maybe something that you as a seller or a CFO helping a CEO sell should be inquiring. What's the idea here? What's their strategy? Where they're going? You could do your own due diligence on them as you go through the process to try and understand uh, what makes them tick and what they're promising as they acquire you. Because down the road, if the acquisition doesn't deliver what they were expecting, that's when the clock's going to start ticking against the asset and all the project in general. So
Mm.
I cannot be precise on timeline. With
Mhm.
families, definitely they're going to be looking at buying and holding for at least 5 years. Most of them can be 10 years or more. It will all depend on how the asset fits with their overall portfolio, with the overall family, say, situation and goals. So again, do your diligence. Try to understand what they're doing with these assets. Try to understand what their goals are, what their objectives are, and then you're going to have a better grasp on that timeline. Because I know that talking 10 years plus in today's world sounds like a little bit too optimistic. But yeah, we've seen deals that can go over 20 years because the asset just came in hand to their strategy, just made sense to hold. So it's all about, but it really depends on that buyer and that family. Lastly, search funds, they're going to be sort of a hybrid between the patients of a family office or rich family and the private equity. A lot of these search funds, although they'll say, I'm not willing to sell, and yes, they're not looking to sell necessarily, not initially, they will at some point, because they will want to reap the return and the benefit of all what they brought to the table and what they executed on. So the good side of that is that normally those guys run on a freer or less strict mandate. They actually many times rose capital with someone, and as they had that capital with them, they made their own promises there. But I bet that anyone playing in funding search funds knows that they're typically going for companies that are under the radar of private equity, which means that they need more time to make things work. Uh, I would say that it's at least 3 years to make a company minimally attractive to a private equity. But in the reality, it should be more 5 to 7, if not more. Again, Blaine, I'm sorry to repeat myself here. You got to understand that buyer. As soon as
Mhm.
you really see there's a transaction to be had here, you do your diligence. You ask them and you try to make sense of where they're going and see if there's a fit for you.
So I'm curious if outside of the strategic, I suppose that would be a little bit of an exception. Are any of the others ever a buy and hold? Because I suspect that strategics are commonly, especially in software, they literally will buy and hold and roll it into their business model. Do any of the other ones ever buy and hold, or is it virtually always the intention to sell and earn some dollars off of that?
some of those search funds might be the buy and hold because, again, if they are corporate America exile, probably a big executive with lots of cash, they might be looking for a long-standing, say, job for them. It might be a way of placing them in the buy and hold category. But the definite buy and holds here are when you either do an internal transition and you do an MBO where your own management and your own employees are buying you out, or you structure an ESOP. Uh, the difference there normally size. ESOPs, they tend not to work well for companies with less than $5 million in EBITDA. There's a lot of costs associated with that structure. The structure is great, by the way, but they normally cater for bigger companies. Now, if you're sub 5 million and you're not that well structured or cannot pay for all that structure, yeah, maybe an MBO would work. And then I would bet that those executives acquiring from the founder are going to be there for the long run, and you can consider them buy and hold types.
So, beyond financials, what are these different types of buyers looking for in a business that would make it attractive for them to buy?
Um, Beyond financials, there's that asset fit. So if I'm a PE, again, the playbook is pretty clear. Is this asset going to be a bolt-on into my roll-up strategy? So it's just another asset. I already bought 3 assets in that industry and buying the 4th. Well, you know exactly what they're going to do there.
Mhm.
And then where do I fit in their strategy? Where do I fit in what they're trying to do? Right? Strategics. Yes, ultimately all games here are financial, but maybe I am dominant in a market where one of those strategics aren't. Maybe they're openly and actively seeking to expand towards my geographical area, even though I'm not dominant. I'm big enough that I'll make a splash and make a difference for them. Now, do they fit into the company? Because if the culture is completely different, if the systems are completely different, I've seen cases where people build companies thinking of selling,
Mhm.
and they were just choosing the right types of ERPs that are most used in the industry. Not because they like their ERP, just because they know that at the other side of the table, strategic will look at that and say, oh, by the way, they use our own ERP. And if you've been to a board meeting or a C-level type meeting and you say that, oh, magic words, we're saving money by doing the deal because they're not having all that integration. So that's another type of thing that they could be looking for. I think I told you on families probably has to do with values too. I mean, those
Mm.
family values and how they do business and how they think about business is going to be as important as financials because they plus one of a transaction, price is set and the due diligence is over and everything is said and done. But I can see a lot of buyer or seller remorse coming from not asking those questions like the ones you just asked, not looking at what's beyond financials in that acquisition. So that's I tend to say even more important than price. Price is just a number in the end.
So how can a seller tail the exit strategy to match what that buyer likely wants?
I always say this, start with the end goal in mind. So what do I want? I want to protect my people. Probably strategic is not the best. I have no problem. I built this company for efficiency and that efficiency culture is here. Probably PE is your guy. No, I value legacy. I value making an impact in my community, family offices. So what you start doing is, okay, what do I want to accomplish with that sale beyond, again, just selling? What do I
Mhm.
want happen to my business and to my asset after I'm done and I'm hopefully enjoying life either by starting a new venture or doing something else with my time? Uh, by answering that question and being very honest about that, then you go and you're gonna pick, okay, how am I gonna attract the attention of that right buyer? Again, you don't need 10
Mhm.
buyers. I see people there saying, oh, I got 10 buyers. You don't need 10 buyers. Maybe you need 2 or 3 just to make it a little bit more interesting and having some competition, but you don't need
Mhm.
10. So what I want is make sure that 2 or 3 strategics or 2 or 3 funds at least look at me and say, wow, I like this. It fits my strategy, which again will make them be more eager to acquire the asset.
So I also want to dive into an area here about the valuation itself. So I'm curious, What are the different ways that besides a multiple of revenue? Because I know like that's the most common thing, a multiple of revenue, a multiple of EBITDA or whatever. But there's other ways, especially with the strategic, that I believe they're likely see value in a company. How do you start, and how do you think about putting an actual price tag on a business that would make sense to the market?
That's a great question, and very often misconception. So when you think of, I'll start with PEs because yeah, you said it is as simple as okay, 6 times your 5 million EBITDA, 30 million company. That's what I'm paying for. That's what you deliver, and that's it. Now people often say strategics pay more. Why do they pay more? That's what you're asking, and the answer to that is well, if a strategic sees that this company makes 5 million EBITDA and actually I have a 2 million opportunity in terms of synergies, either because I can capture more market share just because of that location, or I can save a lot in terms of back office and in terms of cost synergies. And let's say that altogether is a $2 million EBITDA opportunity. Guess what? Paying the very same multiple, I could be paying at least another 12 million more, right? So my $30 million valuation becomes potentially up to 42, if not more. If I'm not so eager for that as a strategic, I'll end up increasing and paying a higher multiple to have that opportunity. So it's way more than just that number. Again, it probably includes shedding off some expenses, and depending on your industry, this probably means some reduction to headcount on your company. But it's part of that game. Did I make myself clear?
Yeah, no, that does help, and because I know it's always a tricky question with the different types of like, let's say you're going to sell a business right now. Um, is there an area that seems to be a little bit more active right now, from like PE all the way through to search? Is there an area? Is there an area that tends to be really active, or maybe really aggressive on pricing, or is it just very much kind of case by case?
It very much depends on the industry you're talking about, because each industry, each space has its own, say, market cycles, right? But generally speaking, we are amidst and continue to be for a few years. We've been actually private equity dry powder is just beating record after record. So second quarter was the first time in a while where you're seeing some of that dry powder reducing. But guess what? They went on the road, they raised more capital. Now Q3 came in, and Q3 data is already showing that the dry powder is going up again, which is one of those, right? The market chases that return, they see the activity, they go after it. If you're talking about strategics, and if you think of listed strategics, just look at where the S&P is right now, and you're going to see, well, all-time high means listed world valuations are at all-time highs in general, meaning, well, if I need to acquire, if that's part of my strategy, I'm probably looking to the private world for opportunities, which might mean more activity there, especially with interest rates coming down, which, by the way, helps both, right? They tend to
Mhm.
lever up on those acquisitions, and with interest rates coming down, they have a bigger opportunity to go and fetch acquisitions right now. So pretty active scenario, and a lot of sellers too. We're amidst the silver tsunami. A lot of people, a lot of baby boomers retiring and reaching that age where they're looking to the next chapter in their lives. So lots of assets out there too.
Is there any difference or trends happening right now, just because of it's almost like a unique level of instability since COVID? Like in the last 5 years, there's inflation and the tariffs right now and things like that. Are there other factors here? How are they affecting the M&A world right now? Is it starting to be back to norm? Is it a little sluggish? What are you seeing right now?
We are starting to see activity pick up. And remember, we started a year with a very important transition in power in America. So up until late last year, you could see people a little bit taking a breather and taking a pause, trying to understand where things were going. As soon as the potential result will started to unfold, you could see some actors out there. I have a lawyer friend who told me, I'm busy like I wouldn't expect, and this is still November. And the guy was saying, well, everybody's trying to pull the trigger now, exactly because they think that most people think that it's not the time, because those guys are moving to try and stay ahead of the curve. Now, we came into 2025 and we had the transition in power, and we came in, we were pretty shaken down in terms of policy, right? So as the country took a very steep change in terms of policy in general, that had its impact too. Obviously, the tariffs and all the discussion, and there's going to be a tariff, there's not going to be a tariff, had an impact, especially when you're thinking of sectors like manufacturing. Um, AI, a lot of focus on the government on making sure that money is deployed in AI, and all the listed players talking and banging the drums on AI makes anything that has AI in it, even the ones that are not really AI but just sell themselves as AI, be booming. So
Mhm.
there are some spaces where things are heading. To the opposite side, think it real estate, think it retail, think any space where interest rates are a massive factor. Right now, you might see things shifting, but up until now, we didn't see a lot of movement because we were until very recently on that wait and see mode on the interest rate front, which is now
Mm.
changing.
Yeah, yeah. Uh, this is really interesting. Is there any other key trends that we should be looking out for over the next, like in 26 or even just over the next 4 or 5 years that you expect to come into play, or do you think it will just start to settle in?
One, and that we touched upon, is the growth of search funds, the growth of that type of operator mindset type, because one of the key cultural changes that COVID introduced is I don't necessarily need corporate America. If
Mm,
I have this other pathway, I can go. A lot of people went solo. A lot of people went, digital nomad to operate single operator type deals happening. So I see more and more people doing that. I've actually read an interesting article the other day about some of the PE funds actually going to the MBAs, and instead of trying to hire them, I'm going to fund your search fund,
mm,
because some of those guys would not want to go and grind in Wall Street. Uh, Cultural change post COVID. But, well, if you want to give me capital so I can make those acquisitions happen, it might make my life easier. I might not have to be restricted to a 5 million SBA loan. I could do something bigger, right? And bigger normally is safer. So yeah, search funds and how they've been growing, and as a trend, I'm seeing people now starting to structure their own search funds, as opposed to it needs to be a big bulge bracket private equity type name doing anything like that. Yeah,
mhm.
that's a key trend, and something that will shape, especially in the smaller world of sub $5 million acquisitions. It's gonna make a difference.
Mm. So tell me a little bit about you and TD Pine Advisors. What do you do, and how should people get hold of you?
Well, thanks, man. We at TD Point Advisors, we help business have options. That option doesn't necessarily need to be a sale, but they need to structure their business to get whatever they want. We talked about it here. Have their goal in mind. They normally come to us. This is what we're going to do. We want to make sure that the next generation can take on the business. Okay, let's structure a business for that. That's what we do in a nutshell. And we work with CFOs, CEOs, founders, boards to put a plan together in a very hands-on way to execute alongside them. We're not just prescriptive. Here's your plan, go execute it, because we know those never get executed. So we're going to come in hands-on and do it. If they want to reach out, we have a website, tdpineadvisors.com, or they can reach out on LinkedIn. Both me and Brendan Moon, my business partner, we are very active there in the space. So just send us a message. Let's chat. Let's talk about it. We're here to have a conversation and figure out how we can help.
That's terrific. Thank you so much, Rafael. This was a great conversation. You got to answer some of my questions that I snuck in. Yeah, not some of the ones you had mentioned before. I actually had questions here, so I want to sneak them in. So I really appreciate you letting me do that. And if you're a CFO out there, you're on a finance team, and you are struggling with cash flow and spreadsheets, come see us at Dry Run. We will get you out of those complex spreadsheets. We're going to help you and your team save a ton of time and bring a ton of clarity to management. Thanks again, Raphael. I really appreciate it.